Hey, hi everyone. Welcome to another video. And today we are going to discuss about one of the famous investment strategy, which is called as pyramiding and reverse pyramiding. And we're going to discuss some examples of this technique investment strategy called pyramiding and reverse pyramiding, and how this strategy can be used in the Indian market, and some specific examples to demonstrate these concepts. Okay. So, what is pyramiding and reverse pyramiding? These are, position sizing techniques used by traders and investors to manage risk and maximize gains. Okay, so first let's come to pyramiding. Pyramiding is a strategy where a trader, takes an initial position, which is a small position, and as the trade goes in his favor, and he follows the trend basically, and as the trade goes in his favor, he starts adding to the winning position. Okay, and so that is what is a pyramiding. So okay, you add to your winning position, and the idea is to scale into strength and compound the profits while keeping the risk controlled. So how it works, basically pyramiding works is you start with a small initial position, and as the stock price rises to a pretend determined profit milestone, then you add smaller amounts incrementally. Okay, and always you maintain a higher average buy price, reducing risk of drawdown. The famous traders who have used this pyramiding technique in investing are Jesse Livermore. He is a legendary trader who emphasized adding to winners and not losers. Okay, and Richard Dennis, turtle trader, who advocated trend following with pyramiding in futures. Okay, reverse pyramiding is exactly opposite of the pyramiding. So here you start with a large position instead of a small position, and you reduce it gradually as the position moves in your favor. This is generally done by in options trading or short-term trading to book profits. Okay, so that you can book the profit and reduce the risk. Like for example, you took a option trade in the morning, and you know that this is going to go in your direction. You took like 10 lots. You're gonna take 8 positions out, book the profit, and leave those 2 positions with trailing SL. So that's what is basically reverse pyramiding. Okay, so how it works is taking an initial large position. As the price increases, you book partial profits by selling smaller chunks, and use to lock in gains while riding a trend. So that is what is the reverse pyramiding all about. Okay, so pyramiding is, adding the positions while you're riding the trend, and reverse pyramiding is taking a large position initially and booking the profits, and then again riding the rate trend with smaller positions, so that you lock in gains. Okay, Indian stock market examples for pyramiding are Dawat, if you take, which is LT Foods. Time frame is Jan 2023 to December 2023. The price has moved from 100 to 250, which is around 150 plus returns. Okay, and the example of pyramiding in this case is, buy 100 shares at 100 rupees first, and once it moves to 130 you add a 50 more shares. Once it moves to 160 you add 30 more shares. Once it moves to 190 you add 20 more shares. Okay, so that's how this is what is pyramiding is all about. Okay, now you're essentially holding 200 shares, averaging the average cost is only 127 rupees. Okay, why this will work is because of strong fundamentals the company has, improved earnings it has, and technical breakout it has, and it's, giving a 150 plus return. So, and it's moving up and up, and while your trade is, you're winning, basically this is a winning trade and you're adding to the winning trade. Okay, thus making more profit. Reverse pyramiding example is Nifty 50 bull run 2020 to 21. So April time frame is April 2020 to October 2021. In that bull run, the price has moved from 7,500 to 18,000 plus. Okay, so example of the trade for reverse pyramiding is buy one lot of Nifty futures at 7,500 rupees, sell 30% at 10,000 rupees, and sell another 30% at 13,000 rupees, and finally 40% at 18,000 rupees. This could be another example also. You could buy 10 lots of Nifty futures at 75,000 rupees, and then sell 3 lots, and then sell 3 lots, and then sell 4 lots. Okay, that's how also you could do. Or you could sell 7 lots, and then 3, and then 3, or you could do 8-1-1 also, you could do. So that's the reverse pyramiding technique. Here you are booking the profits. Okay, you're booking the profits, locking the profits, and since you don't know how long the market will go up, wherever your profit margin is met, that you book, and then you let one or two lots to just go in. If it goes in your favor, you book it, or it will just cut it, sell for you. Okay, so that's a reverse pyramiding technique. While in the pyramiding technique, you are adding the positions after a predetermined level, because you expect it still to go and go, and you're confident that it will go. Okay, and there, because of the fundamentals. Okay, why this has worked is momentum post COVID stimulus and steady trend. Okay, comparison. So in the pyramiding, the positions start size is small, whereas in reverse pyramiding it is large. And the risk management, it builds exposure gradually. As your trade is successful, then you add to that trade. Okay, in the pyramiding, the reverse pyramiding, you because you took a large trade initially, a position, you reduce that exposure. Okay, you book the profits, and reducing the exposure in the reverse pyramiding. Ideal for pyramiding is ideal for trending markets and long trades, and reverse pyramiding is ideal for booking profits and volatile moves. Famous practitioners for pyramiding are Jesse Livermore and turtle traders, and reverse pyramiding are discretionary traders, option scalpers. Okay, and yeah, it's giving some tips basically to use this only in trend following stocks like Tata LC, ITC, MRF, Jumble Fertilizers during bullish phases. So basically, use these techniques in bullish phases, and you use stop loss and trailing exits, and you don't do pyramiding in choppy and sideways markets. You need to do it in a trending market. Okay, and always focus on sector leaders or breakouts like IT, FMCG, auto, pharma, or common sectors where pyramiding works. So this is about pyramiding and reverse pyramiding, guys. So a famous investment strategy, and some legends are there who have used these, like this Livermore and Turtle Traders. This is a very famous strategy. Turtle Trader Richard Dennis. Okay, so I just wanted to cover this also as a part of our investment strategies. Thanks everyone for joining the call. Have a nice day. Bye.